Good afternoon, ladies and gentlemen, and apologies for the delay in the starting of the Downing Renewables and Infrastructure Trust PLC investor presentation. Throughout this presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted any time via the Q&A tab situated in the right-hand corner of your screen. Simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company review all questions submitted today and publish responses where they're appropriate to do so. These will be available on your Investor Meet Company dashboard, and you'll be notified once these are available for your review. I'd also like to remind you this presentation is being recorded. Before we begin, we'd like to submit the following poll. I'd now like to hand you over to Tom Williams, Partner and Head of Energy and Infrastructure, Tom Moore, Partner and Head of Asset Management, and Henrik Dalstrom, Investment Director. Good afternoon.
Thanks very much for that, and hello everybody. Thanks for joining us today, and we're delighted to be able to take you through the first quarter results of Downing Renewables and Infrastructure Trust. So, just a few important reminders here on the slide deck. We'd be grateful if you could read through and take you straight through into what we're trying to cover today for you. So we're here to remind you of Downing's Renewables and Energy Infrastructure Trust strategy, give you a quick reminder about who Downing are, give you an update on the performance of the fund in the quarter, and then run you through what the portfolio looks like today and what that pipeline looks like for tomorrow. So on with you on the call today is myself, Tom Williams. I head the Energy and Infrastructure practice here at Downing and have been in the energy and infrastructure space for more than 20 years. I have with me Henrik Dalstrom. Henrik is an investment director in the energy and infrastructure team, and he has a specific responsibility for the Nordic region for us and here at Downing. Prior to joining Downing, Henrik spent 17 years at Macquarie's infrastructure and real assets business. Tom Moore is also with us, delighted to have him on today. He heads our asset management business. Downing has spent a great deal of time and money bringing in-house its asset management functions, and Tom's built up a considerable team in that space. And prior to joining us, Tom spent 5 years at Foresight, where he performed a similar role. So just a quick reminder of who Downing are. We have been investing in this space for more than a decade. We've made more than 100 investments. We've returned more than a 9% IRR to our investors in that time. We have about 180 staff. We have 31 of those specializing in energy and infrastructure, roughly split half between our asset management team and our investment management team. And we do take responsible investment very seriously. We have set out in some detail the manner in which we incorporate the principles of responsible investment into our investment processes in the prospectus that we published last year for the IPO. And what we wanted to focus on here for you today was some of the ways in which we capture that information and report it. And Tom will be delighted to take you through that later on. So here, just a reminder of the strategy for DOR. That strategy is centered on diversification. We really do believe that diversification increases the stability of returns and broadens that pipeline of opportunities for us. And we really think that this quarter is a real vindication of this strategy. So how do we think about diversification? Well, we think about it in a number of different ways. First of all, by technology. So each different technology is dependent on a given natural resource. Those natural resources are variable and they are seasonal. And so as you invest in more different technologies, you reduce your reliance on any given natural resource. When you move geographies, you can access different natural resources and therefore different technologies. And you can also access different political and regulatory regimes, and most importantly, different energy markets. All of the energy generation assets we have sell energy into energy markets. And if you are investing in assets which sell energy into different markets with different fundamental drivers, you can achieve different outturn pricing and reduce risk. We think that, again, this quarter is a real example of how the benefits of that strategy, and particularly we can see the benefits of the different energy markets that we've invested in. Investing in construction projects also provides attractive risk-adjusted returns. And so then the combination of the diversification by technology, by geography, and by project stage results in a diversified set of revenues. Important to mention again that we are focused on that merchant power price exposure. So that's another key driver for the fund, and it's a theme again we will return to as we go through the presentation. So what does the portfolio look like today? Here it is. We have 8 operational hydroelectric plants in Sweden, spread across 3 different rivers in 2 different price zones. And we also have a portfolio of operational solar parks in the UK, which are spread across England, Wales, and Northern Ireland. We wanted to give you a quick update on the investment activity in the quarter. So I'm going to hand over now to Henrik, who led the acquisition of the hydro portfolio for us, and he can take you through what that looks like.
Yeah, so earlier in the year here, we acquired 8 hydropower plants in Sweden from Fortum. The transaction value was the equivalent of just under £60 million, and the assets are held in a company that we now call Hydro AB. In order to understand the attraction of these assets, it's probably worth taking a step back and consider the Nordic energy market. Whilst about 50% of the power in Sweden comes from hydro generation today, effectively no new hydropower plants are being constructed. With electrification of societies, there's an increased long-term demand for electricity. And importantly, hydropower is the only renewable energy source that today is dispatchable. Hydropower is and will remain a key energy source in the move towards 100% renewable energy society. And consequently, it's expected that the hydropower will become more valuable in the long term. The portfolio we have acquired has a very good level of diversification across rivers and price zones that Tom's just mentioned. And as you can see on the table on this slide here, the hydropower plants, they were commissioned between 1942 and 1962. So it's highly proven technologies, and these are plants with significant operating history to them. The expectation is that the hydropower plants will continue to operate for another 80 years at least. Also, acquiring a portfolio of a reasonable scale that we just have done also means that we're in a very good position to make further attractive bolt-on acquisitions in the future. In the Nordics, hydropower is a baseload energy. It has also become increasingly important source of dispatchable energy as Sweden is decommissioning its nuclear power plants. The last nuclear power plant was decommissioned was at the start of this year. The market also sees more and more interconnected cables from the Nordic region to Europe and the UK, and this aims at exporting electricity. So the long-term demand is consequently expected to increase. The portfolio we acquired has 25.6 megawatt of capacity, and in an average year, it produces about 109 gigawatt hours. What is also really exciting about this portfolio is that it's all the hydropower plants are fed by over 20 significant reservoirs. And this means that we have a dispatchable portfolio. That means in turn we can optimize the production, and that's throughout the day. It's between weeks, months, seasons, and even years. And this is one of the reasons why we're so excited about having acquired a portfolio of perpetual renewable energy assets. These are assets which are expected to provide growing and very long-term cash flows.
Thanks, Henrik. So just moving on to the solar assets, it's a really nice portfolio of operational UK solar. It's about almost 100 megawatts. It's split across commercial, residential, and ground-mounted solar, and with the majority there of the capacity made up of ground-mount projects. Just a little bit more about the portfolio for you. It's almost 3,300 individual installations spread across 48 companies, so it's highly diversified. It's got a long operating track record, 6 years now, and because it is a portfolio that has been operational for so long, it benefits from substantial subsidies, which provides a high level of fixed revenues for the portfolio. And on top of that, there are still some merchant sales, some sales of power to the electricity grid. There are minimum price, so what we call floor arrangements in the power purchase agreements, the sales agreements for electricity, for a great deal of the what would otherwise be merchant power sales of the portfolio. What does that mean? That means that we've got significant downside protection against negative price movements in wholesale power. Last but not least, this is an opportunity that is currently under exclusivity to the fund. That was again announced during the quarter. It's the opportunity to fund the construction of a 100 megawatt nearshore wind farm in Sweden's largest lake, called Lake Vänern. A fantastic project we're really excited about. It's quite a significant project, so the fund will co-invest alongside other Downing managed funds and the developer in order to fund the project. And at this point in time, the project is still in development. It's not yet reached a point where it's suitable for investment by the fund. So we're just working with the developer to help them through that procurement phase where they are currently tendering for the kit, particularly the turbines, to go to be used in the project. So what does that mean as we stand today? Well, this is the portfolio. We've got a breakdown by technology on the left-hand side there, so hydro and the solar assets. We have the breakdown by power market. There are 3 different power markets that we currently sell energy into: the Swedish market, the GB market, and the single electricity market, which is the unified market between Northern Ireland and Ireland. We have 100% of the portfolio that is operational at the moment, so we've got zero construction exposure as we stand. Now, this is a key one for us. What we're trying to show on this slide here is how we manage merchant power price exposure. So the first year here, year 1, that is calendar year 2021. That is an expression of the breakdown of the revenues of the entire portfolio. And what you can see there, which is in hashed grey in the top left-hand corner, is a small slice of merchant power price exposure. And the rest of the revenues of the portfolio are fixed. What you can see on the right-hand side is what that looks like in 10 years' time, as we stand today. Now, the difference between the two is essentially an expression of what we can do in the short term and what we can do in the long term. So for the long term, that's what you see there in year 10. You've got long-term subsidies, you've got some long-term fixed price power arrangements. And when you come closer to year 1, closer to the present day, we can do more to fix power. So for instance, in the Nordic markets, we can fix power for about 5 years out. In the UK markets, under our current arrangements, we can fix about 3 years out, where we can fix about 6 seasons ahead. And also, point to note here is that merchant power price exposure does get a bit larger in the later years because power prices themselves grow in real terms, forecast to grow in real terms as we in the future. So that's an explanation of the two approaches. Clearly, as we roll forward the years, we'd expect those years to look more like year 1, the closer to us that they get. So we talked about at the top of the presentation how we are monitoring and reporting on our ESG metrics across the portfolio. Just wanted to hand over to Tom Moore, who heads the asset management business, to take you through this slide and also the results.
Thanks, Tom. Afternoon, everyone. The solar and hydro assets that we manage today offer us a great opportunity to support and enhance the local environment and to ensure we're engaging positively with local stakeholders. We feel a great sense of responsibility in ensuring the health and safety of contractors, the general public, and other stakeholders, as well as making the most of the opportunity we have available to us. Impact is upon positive and across a wide range of factors. One example of this is the work we're doing in enhancing the biodiversity on and in the land and water that we manage. on a day-to-day basis. We set out a few of the stats on this slide that our team manage and collect on a day-to-day basis. We don't like to look at these stats in isolation. We don't see them offering great value as static numbers. What we spend a lot of time on is measuring our progression against targets that we weave into our asset and portfolio optimization plans. And we look to maximize the impact that we can have wherever we can at every opportunity. These factors will be central to our regular reporting to our investors. We're really excited about sharing that in our interim and annual results, and we'll make sure that reporting is focused on the progression that we can show to the local environment and public. Moving on to the performance from a NAV perspective during the quarter. The investments we've spoken about have taken the gross asset value to a little over £200 million. NAV increased by 1.3% during the 3 months to March, and we've set out a lot of the drivers to that increase within this chart here. We appreciate it's early days, but you really do start to see the outcome from the strategy coming through into the NAV performance. The UK solar bridge we show there is net neutral from a NAV perspective. That's because we were able to incorporate the latest downwards movements in UK power prices and increases in UK corporation tax into the transaction price, therefore had no impact on the fund's valuation. And you'll see the largest uplift from the NAV came through the Swedish hydro portfolio. And I'll hand over to Henrik to walk that through in a bit more detail.
Thanks, Tom. Since acquisition, the portfolio has increased by 3.6% in value. And there's a few reasons behind this. Firstly, there was a very strong operational performance during the period. At acquisition, the reservoirs for the hydropower plants were well filled. The winter and the spring were relatively cold in the Nordic region, and cold winters means increased demand for power. Our generation was up 19.5% during this period. Cold winter also meant higher power prices, and that's relevant for the part of our production that is unhedged. And on top of this, we had sound cost control. The net effect was that the operating profit was up 400% above budget. The NAV growth was also positively impacted by an increase in the long-term power price forecast. So this is the opposite to what happened in the UK. And finally, there was also some positive impacts from execution of the hedging program. The solar portfolio in the UK was acquired in March 2021. The acquisition took into account the latest power curves and the increase in the UK corporation tax. And whilst held only for a short period of time, the generation and the power prices combined produced revenues in line with budget, and there were some cost efficiencies which drove the operating profit up 15% above budget. Looking at the leverage for the portfolio, overall borrowing stands at 33% of GAV. The solar portfolio has about £69 million of long-term debt from Aviva and a further £11 million from BlackRock. Downing Hydro was acquired using 100% equity, and that was intentional in order to reduce cash drag at the fund level. Clearly, there's potential for sensible gearing levels to be introduced to this company, which can release cash for bolt-on acquisitions or acquisitions in adjacent sectors. At the fund level, we've started to work to secure a revolving credit facility. The maximum amount drawn here is 10% of GAV, so about £25 million. The principal use is to fund future acquisitions ahead of the capital raise. With that, I'll hand it back to Tom.
Thanks, Henrik. So, what we've got here is just some good news on the expansion of our activities in the Nordic region. We are now committed to opening a new office in Sweden in 2021, and that's really as a result of just the amount of deal flow we're seeing, the amount of activity that we're experiencing in the Nordic region, and also some other news we've got on hires. So we're very fortunate to have Magnus Olafsson join us. He is an enormously experienced professional in the renewable energy space. He's a board member of the Swedish Hydro Association, and roles include being formerly Director General of the Swedish Electricity Safety Board, amongst other things. So, fantastic to have a person of Magnus's caliber involved with us in the Nordic region, and bodes well for us in the future. Equally pleased to have Per join us. Per is an experienced civil engineer, has been working extensively with OX2 and others on construction of wind farms, and with a particular focus on health and safety and construction management. A number of different opportunities in that construction space for us, so very, very keen to have Per join us, and delighted he's doing so. Also, just in London, to let you know that we've also had another director join us, again focused on investment in the wind sector. So again, really delighted that Roberto is on board and working hard on opportunities for Door. Talking about opportunities for Door, that takes us neatly on to pipeline. And the short message here is that there are opportunities across the geographies, across the technologies that we're looking at, and the pipeline is extremely robust. In the hydro space, we're seeing a lot of bolt-on acquisitions, either of individual or small portfolios of hydropower plants, and we think that that's a real area of growth for us. So plenty of opportunities there, a number that are under consideration at the present time. In the utility space in the Nordics as well, very similar type of assets to hydro, in that they are perpetual assets. So that is assets that have very, very long lifetimes, not defined life assets like a solar park or a wind farm that have a sort of natural life to them, and then they don't really have any terminal value. These opportunities are also really interesting for us in the utility space, because they don't derive their revenues from the sale of electricity. They derive their revenues from regulation. They get to charge their customers a certain amount that's permitted by the regulator. And so when you think about that in the context of managing our merchant power price risk, they're great assets to do that, because they don't have any. The solar portfolio is quite a widespread one in the UK. We're still looking at ways to add to that portfolio. There are secondary market opportunities, so acquisitions of operational assets in the market. Pricing is generally quite tight in the market at the moment, so those are relatively expensive, but they're still out there and still attractive. And we are spending a great deal of time focusing on construction-ready assets. Solar parks don't take very long to build, so that is good for yield. And the thing, though, to focus on, as with all new build renewable projects, is the revenue structure. And so we're very focused on our off-take arrangements, our power purchase arrangements, and trying to make as much of the revenue as possible fixed in nature. That comment goes for wind projects as well. There is a more developed PPA market in the Nordic region, and so the wind projects that we are looking at tend to benefit from that. And there are opportunities both in the operational and in the construction phase. That's RTB, right, ready to build. That's what that means. And they're present in all sorts of countries across Northern Europe, including the UK, and in all sorts of sizes. So there are plenty of opportunities for us to look at there. So I think from our perspective, a really exciting landscape for us at the moment. So what does that lead us to? Just then to recap, I think the strategy is really bearing fruit at the moment. We've talked about that performance, both in terms of the operating performance that was possible because of accessing a different technology in a different geography, and also the NAV performance. And part of that NAV was driven by the long-term forecasts for power in the Nordic region, which are positive. They have moved upwards relative to the long-term forecasts that have been released this quarter in the UK, which have been slightly downwards. So again, the benefits of investing in those different energy markets with different fundamental drivers. We are 83% invested at the moment. That is quite a considerable amount of capital, and well ahead of the schedule that we set out for ourselves. You know, we said to our investors that we would be invested in 12 months, and so the rate of deployment, along with the strong cash generation, the strong operating performance of the assets, puts us in a very, very good place when we start to look at our dividends for this year and for the overall fund performance. So with that, on that kind of positive note, that's where we end the formal part of the presentation, and we'd be delighted to take any questions from here.
Tom, thank you very much indeed, and thank you to the team for the presentation. Ladies and gentlemen, do please continue to submit your questions using the Q&A tab situated in the right-hand corner of your screen. But just while the team take a few moments to review those investor questions submitted already, I'd like to remind you that recording of the presentation, along with a copy of the slide and the published Q&A, can be accessed via your investor dashboard on the Investor Meet Company platform. I'd also like to remind you that your feedback is important to the company, and immediately after the presentation has ended, you'll be redirected for the opportunity to provide your feedback in order the company can better understand your views and expectations. Perhaps just before we move into the live Q&A, we did have one pre-submitted question. If I could just read that out for you guys. Can you give some more information and update on the likely start of the dividend payment and the current forecasts moving forward? What yield do you have in mind that will be stable? And do you think the commencements of dividends will narrow the current discount?
Yeah, thank you. I think we do think the yields are going to be stable. I think this whole strategy is designed around trying to make that as stable as possible. Yeah, absolutely, that's the plan. In terms of the current discount, there are a couple of questions about the current discount. To be honest, we don't really understand why the stock is trading at a current discount. We are delivering on what we have told investors. We are ahead of our deployment schedule. We are exceeding our operational target returns. So we really do feel that this is a fund that is heading in the right direction, and we feel that relative to other funds that have had to absorb some of the knocks in the UK market recently, you know, we've managed to avoid that by virtue of the timing of acquisition of those UK assets. So what we're hoping is that people, now that we've produced a quarterly set of results, you know, perhaps people were waiting to see what performance will be like. We're hoping people will realise that and realise that perhaps this slightly different strategy is producing a slightly different result.
Fantastic, Tom. Thank you very much indeed. Obviously, we've had a number of questions submitted during the meeting itself. If I could just ask you just to click on that Q&A tab and then just read out the question where appropriate to do so and just give your response to it. That'd be fantastic. Thank you.
Yeah, so I'll sort of try and read through them and maybe call in the others to try and help out. So the first one is about the timing of dividends and asking whether, if it's still the policy that dividends will be declared and paid quarterly. So that is absolutely right. So I think might be some confusion about when the first one is. So the first one will be announced in September, and that will be with respect to the quarter ending in June. That's right, isn't it, Tom?
Yeah, that's correct. It'll be plans to announce alongside the interim results, which will be published at the same time, and we'll pay that as soon as we're able in the following month or so after announcement, and then quarterly thereafter.
And then the second question here: how far in the future do the PPA floors remain in place? Tom, do you want to take that one as well?
Yeah, so the PPA floors we referenced sit across a large proportion of the ground mount solar portfolio in the UK. They have around 8 years left to run on that floor price.
Super. What annual power price decrease do you expect over the next 10 years? And what impact will this have on the annual NAV over the next 10 years? So those are really good questions. What we do on power prices, like other of the listed funds, is we take consultant forecasts, and we actually look at an average of 2. that we take, and there's a long-term projections. Broadly speaking, what those long-term projections show is that they show a growth in power prices in real terms in the near term, and then a tailing off over the longer term. As to what this has on annual NAV, I can't give you that answer off the top of my head, I'm afraid.
Although worth saying that the power price forecasts that we are currently using and transacted on are obviously priced into that NAV. So unless they change in the future, the NAV won't change. But we'll be publishing sensitivities to power prices in line with the peer group in the interim results.
There is one thing that is worth mentioning for this question, which I think is relevant, which is we've talked about two types of assets. One in the hydropower plants and another in the electricity distribution sector, where these are perpetual assets, and so from a NAV perspective, these assets are worth more tomorrow than they are today. Their NAV grows over time, and the reason for that is that you are two reasons. One is you're reinvesting in the assets every year, so you're investing capital to maintain them and keep them operating. And the second is that they are, because they're such long-dated revenues, you're just bringing forward slightly higher revenues in the future as prices and returns inflate. So that is different from a solar park or a wind farm. And I was talking about this defined life asset. What happens there is that those assets yield out not only some actual yield, but also a portion of their principal, a portion of the amount that you've invested every year, because by the end of their life, they're worth zero. And so what you need to do to maintain NAV is reinvest a portion of that yield every year in new projects. Now, we have some of those types of assets in our portfolio. We have solar projects. We plan to have wind projects. But a significant portion of our portfolio is made up of assets that don't look like that. And so there is, in our view, a much more balanced risk in the portfolio across those two different types of assets, and a reduced risk of having to reinvest that capital every year to maintain the NAV. So we've got a question here. What do you see as your key risks, both from an operational and financial perspective? I think one of the key risks that we've identified, that we've talked about quite a bit, is concentration risk. And so we have a strategy that is designed to avoid that. We don't want to be a single technology in a single jurisdiction. We think that concentrates a number of risks. So you're concentrated in resource, you're concentrated in country political risks. So witness what's happened in the UK in terms of corporation tax increases, and you're also exposed to a single market, single electricity market. So for all of those reasons, we think it's better to be diversified. So that is the biggest risk that we've identified, and we've deliberately designed a strategy around avoiding that risk. Now, the second big risk that we see is merchant power price exposure. And we've talked at some detail about how that exposure manifests itself in this portfolio, and how and what steps we take to manage it. We have another question here, which is 3,250 operational solar installations across 48 companies. 48 companies, question mark. Can you explain what this means and why so many companies? We're not really focused particularly on the number of companies. What we're most focused on is the number of individual installations. And so we like diversification. And so the more separate installations we have, the more separate projects we have, individual projects, the greater we are diversified. And what we believe is that then presents less risk for you. So that is what the point we're trying to make with that statistic. Now, 3,000 of those, or 3,000 and something of those 3,250 installations are domestic rooftop installations, so they're quite small. They're on people's roofs, and it's very hard for one single thing to affect all of them. So it's very hard for the grid to go down and shut down 3,000 people's homes. It happens relatively frequently that there's a problem with the grid for a single large solar park, and your solar park is disconnected from the grid. Now, you work very quickly to reconnect that, but that's an example of what the point we're trying to make here and why diversification has benefits. It also has some drawbacks, in terms of systems and processes to manage that number of installations. That is why we have our own in-house asset management team. That's why we've invested millions of pounds and years in building up that team, so that we can effectively and efficiently manage that portfolio. And that's what Tom and his team do on a day-to-day basis. Next question here is, what's the optimal size market cap for Door? Well, you probably have as good a view as I have on what that optimal size is. We certainly think that there is a great deal of space for Door to grow. We would very much like to see Door grow over the 500 million mark and above. There are other trusts in the space which have been around longer than us that are much larger, and we don't see any inhibitions to growth in the strategy that we're pursuing. So there's another question on discount to NAV. I think we've covered that a little bit. The question is it because of the early stage of the trust life? I'm sure that's part of it, and this is our first quarterly set of results. So I'm sure that is part of the reason why we're trying to get a discount at the moment. But we hope that this presentation and the set of results that we're presenting will go a long way to rectifying that. Got another question here. When do we expect to announce the next acquisition? I'm afraid we probably can't give you that. That probably is price sensitive. But what we can tell you is there's a lot of opportunities out there. So please do watch this space. When will Door release the dates for dividend payments? We covered that one, I think, with Tom's comments earlier. Will Door be raising capital to fund the pipeline opportunities? How much and when? Again, we don't have, I think, a definitive answer to that, but I think it's reasonable to assume that if we continue to invest at the rate that we will, then at some point this year, we may well be coming back to investors and asking you to support a further raise. How frequently will fact sheets be published? Tom, do you want to take that one?
Yes, it will be at least quarterly. Yes, quarterly. The content will be more interesting and fuller in terms of the interim accounts and annual accounts. But you'll see a fact sheet quarterly. We see it as an important factor in terms of communicating what we're doing to the investors.
Thanks very much. What steps have been taken to ensure that the stocks trades at a premium to NAV? We're trying to get the word out there. That's the biggest thing we're trying to do. Is we are trying to deliver on our promise to investors, and we hope that investors will respond in kind by supporting the stock. Do we plan a share buyback? No, we don't at this stage. How do you hedge the currency risk? Yeah, that's a good question. So what we do, Henrik has been looking at this in a bit of detail. Henrik, do you want to take that one?
Yep, sure. So we put in place a hedging program for the international assets that looks out in the medium term, hedging the future cash flows that's coming out of the assets. We work together with a company called PMC to develop a framework that's suitable for us.
Thanks, Henrik. So we've got a question here. There's a lot of good news that has been achieved to date, and your portfolio is differentiated against your peer group. Thank you very much. That's the plan. How are you marketing this story to investors, and is there more that you can do to promote the company? Well, look, we are doing our very best to do that, and this is part of that effort. We really are trying to get the word out there, and we'll use all channels that we can to continue to do so, because we think it's a good story at the moment. As a percentage, how much is invested in the permanent assets each year? We don't have a specific percentage target like that. What we do have is sort of limits that we can do. So we can invest up to 50% of the fund in any given technology. So Hydro is one of those technologies. And we can invest up to 25% of the fund in the electricity grids or that sort of other infrastructure set of assets. So I think, though, that the fund is we wouldn't end up with a fund, I think, at both of those limits. I think that's the whole purpose of what we're trying to do is to diversify across lots of sectors, lots of types of assets, lots of different geographies, as many energy markets as we can. Another one on the dividend. Am I right to assume that your announcement to start from September will be based on the 3p paid quarterly? Yes, that's right. And I think we're pretty happy with that, given where we are at the moment. I think we're well set up to support that dividend as we stand at the moment. Is a small fund a disadvantage? And do you expect to issue more shares? Well, I think we've covered that point about being invested quickly. That obviously has benefits for people in terms of returns and avoiding cash drag. So that's been an advantage in that sense. Will we be back in the market? Yes, I think we probably will be. Again, another question about are we planning more fundraisers? Perhaps towards the end of the year. We feel that when the dividend starts will be when the discount will narrow. Your take on that is as good as mine. What we're hoping is actually that people will see that this is a stock that's worth owning and represents good value. So perhaps it'll end at that point. And what's the makeup of the shareholder register between institutional and retail? It's a mix. So it's a mix of a number of different larger and smaller institutions and a number of different retail shareholders. Do we think it's fair to existing shareholders to raise more money at a discount? No, we don't. So I think we would want to see the stock not trading at a substantial discount if we were to go to market. Absolutely. And I think that probably is the.
I was going to say, Tom, you've been hugely generous. You've answered every single question that's come through, and thank you to Tom and Henrik as well. As I say, if there are any further questions, and I think you have, as I say, covered off every single one, so thank you for that. If there are any further questions that will be submitted by investors, of course, you will have the ability to review those post-event. Tom, perhaps before I just redirect investors to give some feedback, just a closing couple of words, if I may, from you, just for the investors attending.
Yeah, well, look, I think a lot, closing observations are really very similar to a lot of the questions, which is just we're at an early stage in the fund. The fund is doing very well. We think the fund represents very good value for where it is today. We don't believe it should be trading necessarily at a discount, and we're doing our very, very best to show people that we are doing what we said we would. And what we're hoping is that our shareholder base will respond to that, and we'll see the share price where everybody wants it to be.
That's fantastic. Tom, thank you very much. Tom, Henrik, also thank you very much indeed for updating investors today. Could I please ask investors not to close the session, to be automatically redirected for the opportunity to provide feedback in order the management can better understand your views and expectations. This will only take a couple of moments to complete and will be greatly valued by the company, so please do give it your attention. On behalf of the management team of Downing Renewables and Infrastructure Trust PLC, we'd like to thank you for attending today's presentation. That concludes today's session. Thank you and good afternoon.